Good afternoon, ladies and gentlemen, and welcome to the Premier Miton Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Premier Miton. Mike, good afternoon, sir.
Good afternoon. Good afternoon and welcome. Thank you for joining us today and for attending our presentation. I'm Mike O'Shea. I'm the Chief Executive of Premier Miton, and I'm joined today by Piers Harrison, our Chief Financial Officer, and right next to me, Joffrey Wilcox, who's our Global Head of Distribution. Together, we're going to run you through the results for FY23, highlighting the key issues that we are seeing in the market. We'll also discuss the outlook for the current year and beyond. We have had a number of questions submitted already, and we will cover these off after the main presentation, or as many of them as we can. But please feel free to post any questions that you would like us to address, and we'll do our best to get through them all at the end of the session. I will actually kick off proceedings with a summary of where we are, how the last year has played out, and where we see the opportunities. There is no doubt that the last couple of years have been a difficult period for the asset management sector in the UK. The rapid increases in inflation and interest rates, coupled with a difficult geopolitical backdrop, have created an environment where sales of mutual funds have been depressed. We have also seen, as an industry, an increase in redemptions as investors have looked to reduce debt or retreat to the haven of cash now that interest rates have risen. Weak flows and depressed equity markets have been particularly challenging, and it has been difficult for us against this backdrop to demonstrate the strategic benefits of the merger that we completed back in 2019, as assets initially rose and then fell back again. Above all, the environment for attracting new flow into our fund range has been as difficult as I have known it in over 30 years. However, we should not lose sight of the fact that we remain a cash generative and profitable business. We have been able to demonstrate good cost control in the more difficult environment of the last 2 years, and our balance sheet remains robust with some 38 million of cash and no debt as at the end of September last year. Our investment performance remains strong over the long term, and we have seen a significant improvement across several of our equity strategies in the very short term. Performance across our fixed income and multi-asset strategies remains impressive over both the short and long-term timeframes. I think it is worth highlighting that the market cycle and the timing of any market recovery has really been out of management's control. So we have very much focused on those value drivers that we can control. And this has led us to build a diversified portfolio of investment strategies so that we have relevant funds that can attract assets when markets recover. For example, adding fixed income, global small cap, and global emerging markets to our fund management lineup. We have also invested in strengthening our distribution and marketing capabilities under Joffrey, who joined us from M&G a little over a year ago, and from whom you will hear in a few moments. We have spent considerable time building and improving relationships with fund buyers by targeting our marketing strategy and focusing our distribution efforts effectively so that we are on the buy lists for when demand improves. We have begun the journey of developing our presence in the institutional market with the hire of a head of institutional distribution and are making headway in this area, which will help diversify our client base over the coming years. We have also started to develop our presence outside of our core UK market and hope shortly to be able to announce a new initiative that will enable us to build offshore fund capability, allowing us to access an even wider client base as and when demand improves. We have also continued to review opportunities to broaden our fund range, access new markets, or develop new investment capabilities through inorganic initiatives, of which the recent acquisition of Tellworth is a good example, and I will speak more on this shortly. I think it is fair to say that our business is potentially more highly geared into any upturn than many of our peers, given the significant work that has taken place in building our product range and our distribution reach over the last couple of years. I would argue that the key drivers of this gearing are our diversification and our strength in distribution and marketing. A good example of diversification and distribution in action has been our move into the fixed income area with the hire of a top performing team from Merian just over 3 years ago. Clearly, it takes time to develop a team like this and to establish credibility in the market. However, we are very pleased with progress to date, and we have now established a strong 3-year performance track record and attracted around 1.8 billion of assets under management for this team to manage. I believe we are now very well placed to attract further assets over the coming years and to really accelerate growth in this key area. As a business, we will therefore continue to invest in diversification and in distribution. We will also keep an open mind about inorganic opportunities that will allow us to support either of these objectives. I believe that the more difficult market conditions of the last 2 years are going to make such opportunities for M&A more rather than less likely. Now, turning to our results for the year, we closed the period with 9.8 billion of assets under management. We note that although markets fell further during October, they have been on an improving trend since November, and we will be updating the market with our current level of assets under management on Friday this week. In general, it is fair to say that the improvement in markets we have seen in the last couple of months has definitely improved sentiment, and our distribution team are reporting an increase in interest for several of our equity strategies. However, from data we have seen across the industry, we think it is probably too early for this improving sentiment to have had a noticeable effect on fund flows just yet. But the improvement in sentiment is welcome nonetheless, and Joffrey will be updating you on trends in the market when he speaks in a moment. Investment performance remains good over the long term. As mentioned, our fixed income and multi-asset funds performed well over the year, although our equity funds found it more challenging as market returns were concentrated at the very top of the market capitalization range. As noted previously, the broadening out across equity markets that has occurred since the end of October has been very helpful for our funds, which tend to run with high active shares and which have greater exposure to large, mid, and small cap stocks, rather than the global mega caps that have been responsible for so much of the equity returns in the last 18 months or so. A good example of this is our mid-cap focused European Opportunities Fund, which underperformed the main European equity index by just over 6% during the first 9 months of 2023, but which outperformed the same index by almost 7% in the last quarter, and the index itself was up by 7%. So things can change very quickly. In terms of adjusted profit before tax, these stood at 15.7 million for the year, and as mentioned, balance sheet cash stood at almost 38 million, and Piers will provide further detail on these numbers shortly. The board is proposing a final dividend of 3p, bringing the total for the year to 6p. Moving on, and as mentioned, the general market backdrop over the year remained challenging, driven by higher rates, higher inflation, and a risk-off approach from fund buyers. In common with other fund groups, we have regular withdrawals from our funds, as well as regular inflows. The net flow position is actually the difference between these two often quite large numbers. If the net flow number is negative, that can be because redemptions have increased, i.e., more people than normal are taking money out, or it can be because inflows have fallen, i.e., less people are buying than normal. And for us, FY23 was very much categorized by the latter. Our withdrawal number was marginally down year on year and has remained at a similar level for each of the last 3 financial years. The main issue for us has been a marked fall in the level of inflows, which fell from around 420 million per month in FY21 to around 240 million per month in FY23. So our net outflow position has been driven by less buyers rather than more sellers. And that is consistent with the general environment for fund flows that we have seen. On this slide, we highlight the scale of the turnaround we have seen in fund flows here in the UK. In the past 2 years to September 23, we have seen 35, as an industry, 35 billion of net redemptions from equity funds. There has only been 1 net positive month for equity sales. We've seen 25 billion of net outflow from UK equity funds, 2 billion of net outflow from multi-asset funds, 1 billion of net outflow from fixed income funds, and it's really only been money market or cash funds that have seen net positive inflow during the last 2 years. So that backs up our contention that the general market environment has been very difficult. But these things go in cycles, and we'll touch in a minute on our views on the outlook, but we do believe that we're past the worst of this recent trend. And that'll be driven by interest rates coming off the top. As we've already discussed, investment performance remains strong over the longer timeframes and is respectable over the shorter periods. And I believe that this leaves us very well placed for when buying demand improves. Just turning to the recently announced Tellworth acquisition, which was announced after the period end. The transaction currently remains subject to regulatory approval as at the date of this presentation, and we expect that to come through during the first quarter this year, all being well. Tellworth is a very highly regarded UK equities boutique that has a particular strength in liquid alternative strategies, being their long-short equity hedge funds. They also have an attractive track record in UK small and mid-cap long-only equities. It is our view that the long-short strategies in particular will be attractive to investors in the period ahead, as we believe that concentration within markets will broaden and the opportunity to produce attractive returns for these strategies will be enhanced. It is also fair to say that Tellworth brings us access to a wider client set than we currently cover, with exposure to family offices and more institutional investors, both in the UK and offshore. This is attractive to us as we believe it will help accelerate our progress in these areas. During the first half of 2024, subject to regulatory approval, we will be migrating the Tellworth team onto the Premier MITON platform to ensure that we deliver financial efficiency and enhanced distribution capability. Bringing Tellworth onto our platform and focusing our distribution efforts will, we believe, allow us to scale Tellworth's assets under management so that it makes a valuable contribution to our overall business. Overall, I believe that the investment case for Premier MITON remains attractive, notwithstanding the more difficult couple of years we have been through. There is little doubt that the dislocation we have seen in markets is creating good investment opportunities for our investment teams. As markets recover and as the incredible levels of concentration risk inherent in them unwinds, our funds will perform well. Our distribution capabilities are well placed to capitalize on this opportunity, and our plans to expand our reach into new markets, both beyond the UK and institutionally, will be helpful in accessing new sources of fund flows. Our investment performance record is strong, and we have a well-diversified product set covering both UK and non-UK equities, fixed income, multi-asset, and now, with the inclusion of Tellworth, long-short absolute return strategies. We have a robust balance sheet that will allow us to weather the current turbulence. We see Premier Miton as being extremely well positioned to take advantage of the many M&A opportunities that are emerging, given our track record of successful execution of previous acquisitions, our strong management team, and our adaptable and scalable operating platform. I strongly believe that we, as a business, are highly geared into the recovery when it comes, and we are well placed to return to growth as sentiment improves. I would now like to hand over to Joffy to talk you through the various initiatives we are working on in marketing and in distribution. Joffy.
Many thanks indeed, Mike. And I wanted really to begin by picking up on a chart that Mike showed earlier, which shows the impact of flows into and out of mutual funds in response to those interest rate moves. Now, when rates dropped from 5% in the aftermath of the global financial crisis to less than 1%, the industry benefited from vast inflows of savers' capital, as you can see, but not just risk capital. So when savers saw an 80 to 90% collapse on the blue line in their income from deposits, they moved from fixed interest funds to replace that income stream. And over time, some of that money also found its way into multi-asset funds. It should therefore come really as no surprise that with deposit rates soaring back above 5%, savers' capital has returned home to cash, or indeed been used to pay down debts such as mortgages, etc. Thus, last year was undoubtedly the year of cash, and not just cash deposits. National Savings also took £7.5 billion in just 5 weeks in August and September last year in their recent 6.2% one-year term bond. So this flight of savers' capital and of risk capital also seeking lower risk-free havens has provided that challenging backdrop that I mentioned for asset managers looking to generate inflow across their range of funds. So the question is, how have we responded to this environment? So whilst equity risk appetite has been rather muted, we have been focusing on establishing our credibility in fixed income funds, as Mike's already mentioned, where we saw net inflows of over £550 million across our range of fixed income capabilities. In response to that flight to cash, we also pivoted our sales and marketing campaign to promoting our UK money market fund, yielding well over 5%, which has also now started to see steady inflows over the last few months. We continue to be known for multi-asset funds, especially in our directly invested diversified multi-asset range, where we also saw inflows of around 220 million. However, I also want to talk about the other growth levers that we are now pulling on. Firstly, let's talk about MPS. The managed portfolio service market continues to grow unabated, with advisors continuing to move away from fund of funds and into other multi-asset and single strategy funds into MPS. And this trend has accelerated over the past year following the introduction of Consumer Duty, with advisors preferring to outsource their clients' investments to a third party rather than selecting the funds themselves. So consequently, with our brand, heritage, and legacy of offering multi-manager and multi-asset solutions to the advisor market, we believe we are very well placed to provide an MPS solution ourselves, which is a project we hope to launch during 2024 to capture market share in what is a strong growth market. Secondly, as Mike also mentioned, we continue to build out the core foundations for generating success in the institutional market. And during the year, we've been very active in institutional conferences, sponsoring and speaking at various events. We're leading with our emerging market sustainable fund capability, whilst also raising our profile and credentials with increasing media activity. And we're now also looking to extend our institutional awareness campaign internationally, which kind of brings me on to my third point on the screen, fourth point, international. So if I look at international, I've just dropped my screen. So when we continue to build out our international reach, we've already done so with 9 funds registered in Ireland. We've already got a third-party marketing partner in Latin America to service pension funds in Chile and Peru. And we already have some assets from Israeli pension funds. And we're concurrently exploring registration of our funds in South Africa as well. And fourthly, like Mike, I'm very excited about the Tellworth acquisition, which not only brings additional UK small and mid-cap capability, as Mike mentioned, but also that new long-short liquid alternatives capability, and thus access to a new cadre of potential investors, such as other institutional hedge fund clients, not just in the UK, but also internationally. And last on the screen, I also think the retirement income market presents a huge opportunity for Premier Miton, which I'll come back to on the next slide. So one of the things I've definitely seen over the past year is that whilst many advisors and wealth managers are aware of our individual fund capability and credibility, the advisor market, in my view, still has yet to fully appreciate the true potential of Premier Miton's offering, bearing in mind our broad depth and strength across all the asset classes and our growing distribution and brand reach. And so we feel we are very well placed to grasp these growth opportunities that lie ahead. Now, over 83% of the invested assets in the UK is owned by those aged 50 or more. So as an industry, across asset and wealth management, we have been focused on that accumulation phase as these generations of investors have grown older. But today, though, the vast part of the addressable market is now getting closer to retirement, or is retiring, or in fact has already retired. Thus, there is now a huge swathe of investors who need income, not just growth. And with higher inflation rates and income that can grow over time to keep pace with the higher cost of living, especially as many consumers expect to live for over 20 years in retirement. Currently, many advisors in the UK continue to use unit encashment to raise cash to provide income in retirement. That kind of worked when capital gains tax allowance was much higher. But with capital gains tax allowances falling and with volatile markets and the associated impact and sequencing risk, the risk of causing foreseeable harm to investors is growing as we await the outcome of that FCA thematic review of retirement income advice. So as a consequence, we believe that we'll see increased focus on those funds and strategies that can generate a growing natural income over time. And with our track record across a number of funds that have grown their income streams over time, we are well placed to benefit from that trend over the next few years. Now, in a world where we cannot control markets and we cannot control client sentiment, what we have to do is focus on what we can control. In distribution, we have to focus on providing the best possible service to our intermediary and institutional clients. So when investor sentiment turns more positive, those advisors and wealth managers and institutional clients will pick up the phone to Premier Miton first. Now, this slide is drawn from a survey from recent Research and Finance, which shows how well our intermediaries know our distribution teams across both the discretionary fund manager and the investment advisor channels, which is testimony to the high levels of service and ongoing contact we have with our intermediaries. And to that end, I can also share that our forthcoming annual investment conference at the end of February, which we aim at wealth managers and investment advisors, we now have over 270 registered attendees, which is dramatically up from the number of 140 attendees who came last year. So, which goes just to show that we're continuing to gain traction in the intermediary market and that our client base is genuinely interested in our investment products and solutions. And from that same survey, we also asked those discretionary fund managers and investment advisors what they thought or what they think of Premier Miton now, Q3 2023, compared to a year ago. And you can see just how much we have moved the needle in just 1 year in terms of clients now recognizing us for our fixed income capability on the left-hand side, where going back to the previous year, there is no mention of this. Furthermore, going back to my other remarks, you can see how consistently investment advisors on the right-hand side say we are well known for our multi-asset and multi-manager capabilities, which also augurs well for our plans in the MPS market going forward. So to conclude, as asset managers, we have to adapt to the changing world around us. Be it the short term as investment sentiment changes across different asset classes, whilst also ensuring that we are strategically well placed to benefit from long-term structural changes, not just in the UK, but also over time internationally. We have a broad suite of products, importantly, to cater for different clients' needs. And we will continue to evolve this lineup, as you can see from the Tellworth acquisition, and the launch of our new Emerging Market Sustainable Fund during the year. In other words, from my perspective and from all of our perspective, the most important aspect is to remain relevant to our intermediaries and investors in helping them to achieve the outcomes they seek and to remain a trusted partner to all. So bringing all of that together, we feel there is significant growth potential for our fund range across the different asset classes, be it fixed income, which is now an investable asset class again with attractive yield profiles, via multi-asset, an MPS with our multi-manager and multi-asset team. And of course, as Mike has already said, as risk appetite returns in due course, we have a broad and well-recognized equity fund range to take advantage of that renewed investor flows into equities. And with that, I'll stop now and I'll hand over the baton to Piers.
Perfect. Thanks, Joffy. So if we turn to slide 15, we've got a summary of the financials, the key financial metrics for the group. The group generates management fees or our income, which is based on the levels of assets being managed. So for FY23, the average assets under management or AUM, as we like to refer to it, for the year was 10.8 billion. So this was down some 14% on the comparative period. Now, the average AUM is the key driver of our revenue, and the decline resulted in lower net revenues for the business and an adjusted profit before tax, as Mike mentioned earlier, of 15.7 million for the year. Now, if we turn to the profit and loss account, the group's opening AUM was 10.6 billion, and at the year end, this had decreased 7% to 9.8 billion. If we look at the sort of the flow position for the year, despite ending the first half of the financial year broadly flat in terms of flows, we saw a slowing of the sales, as Mike mentioned earlier, and an acceleration of redemptions in the second half, much of it in the UK and European equity space. We saw continued inflows into our fixed income and diversified multi-asset funds. However, for the financial year to 30 September, we saw net outflows of 1.1 billion across our product range. So the net revenues decreased by 14.3 million to 66.9 million for the year, which reflects the lower level of average AUM I mentioned earlier. The net management fee margin for the period was 61.7 basis points, so a reduction on 2022, mainly due to the change in the group's product mix. And we saw administration expenses decrease by 5.4 million to 51.4 million for the year. Now, people continue to be our largest asset, but also the largest portion of our cost base, and that comprises both of fixed and variable costs. If we look at the fixed staff costs, these total 22.8 million for the year, so that was an increase of 2.4 million on last year. And that does include 1 million of staff-related restructuring costs, which we completed during the year. At the year end, again, 30 September, the group had 159 full-time staff, and this was actually down by 7 on the same period last year. Now, the variable staff costs, they totaled 9.7 million, which was a decrease of 7.6 million over the comparative period. And these costs move with the net revenues of the group and the adjusted profit before tax. As already noted, the adjusted profit before tax was 15.7 million, being a decline of 35% on the comparative period, with the amortization charge and the share-based payment expense remaining broadly consistent with the prior year at 4.8 and 4.7 million respectively. During the year, we incurred exceptional costs of $250,000, which was following strategic review to cease the development of the group's online portal Connect, and the resulting profit before tax for the year was 5.9 million. We are continue to be focused on aligning our costs with revenue expectations, and good progress was made during last year in that regard. And it's something which we keep under watch as we move through 2024 and the outer years. As Mike mentioned earlier, the group had 37.9 million in cash at the year end and no debt. And if we look at the next slide, Mike, that was the regulatory capital surplus position at the year end after the proposed dividend. Now, the board is proposing a final dividend of 3 pence per share, which will be payable on the 16th of February 2024. And that brings the total dividend for 2023 to 6 pence per share and a payout ratio of 68%. The group has a stated dividend policy, which is to target an approximate payout ratio of roughly between 50 and 65% of the profit after tax, which is adjusted for exceptional costs, share-based payments, and amortization. And the group continues to distribute twice yearly in line with our reporting calendar. So I think that's a quick summary of the financials, and I'll hand back to Mike now for a summary.
Many thanks, Piers. To summarise the outlook, I think market conditions are definitely improving for our sector, and we are amongst the most highly geared plays into this recovery. There is no doubt that volatile markets are creating opportunities for our high-performing investment teams, and the changes that we have made to our marketing and distribution capabilities mean we are well placed to take advantage of these. We do remain, as Piers has said, a highly cash-generative and profitable business, and we do provide a very attractive home for fund management talent with a strong and collaborative culture focused on client delivery. And finally, there are significant opportunities, I think, for inorganic growth at the current time. These opportunities tend to come in phases in our sector, and I strongly believe the next couple of years will be interesting for firms that can identify and execute successful M&A strategies. Our whole industry is building duplicate capabilities across risk, compliance, distribution, ESG, and operations. And for smaller specialist boutiques, these demands can become overly onerous. At Premier Miton, we have an extremely robust and scalable operating platform that can run a significant multiple of the current assets under management. It also has a powerful and well-regarded marketing and distribution team and a management team that's experienced in successful integration of asset management businesses. In short, I think Premier Miton has the potential to build an agile, modern asset management business, offering active solutions to clients both in the UK and overseas. These are attributes that I believe will be attractive and which will allow us to take advantage of the inorganic growth opportunities I expect to see over the next couple of years. I would like to thank you for your attention today and for your interest in Premier Miton. I'm going to hand you back to IMC, who will introduce the Q&A session. Thank you.
Perfect. Mike, Piers, Joffy, thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Piers, Mike, Joffy, we did receive a number of pre-submitted questions ahead of today's event, and as you can see there in the Q&A tab, we've received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Joffy, perhaps if I may hand over to you, sir, just to chair the Q&A session with the team, and then I'll pick up from you at the end. Thank you.
Great. No, thank you very much indeed, Jake. And I'd just like to echo Mike's comments as well. That thank you so much for sharing your time to be with us today. There's quite a few of you who found the question tabs already, so thank you so much for engaging with and asking some of the questions. I think one or two of them we've probably answered as we've gone through the presentation. But what I'll try and do is a few questions that are kind of similar in vein. So I'll try and group some of the questions into overall sort of theme. So let me begin first, maybe, Mike. We talked about that rally coming up at the back end of Q4, and a couple of people are now asking the question, how positive do you feel now about the outlook for equity markets?
I think, actually quite positive. I think I'll caveat that with the fact that as the chief executive of an asset management business, you always have to be quite positive. But the last couple of years have been obviously quite difficult, and I think that's mainly been driven by the sort of dynamic change in interest rates and inflation. And I think we are probably peaking in terms of interest rates, and I think that will be good news in terms of demand. I think a lot of the returns from equity markets over the last year or two have been very concentrated. We're seeing statistics such as Apple has the same market capitalization now as the entire UK equity market. It produces about 97 billion of revenues, and the UK market produces about 205 billion. So we wonder whether these things are getting out of whack. The Magnificent Seven now have the same market cap as the UK, French, German, and Japanese stock markets. So it just feels like the pendulum swung a long way in one direction and will start to swing back. So I think overall we have a slightly more positive outlook on equity markets, particularly in terms of market breadth, i.e. Investors moving out from those very big global mega caps down into the sort of large cap and mid cap area, which is really where a business like ours is incredibly well placed. So yeah, much more positive than we were perhaps a year ago, Joffy.
No, thank you, Mike. And we're also getting a few questions on our M&A philosophy and also about the product lineup that we've got. So maybe let's deal with the M&A bit first, and then we can come on about the product lengths and strengths, etc. So maybe, Mike, so can you just expand a little bit more about sort of the areas of M&A that you've continued sort of looking at?
Yeah, I think M&A is interesting for us because there is an opportunity now where people are wondering about their business after a couple of very difficult years. I mean, Telworth's a good example of that. A very strong team with a great track record who are on their own in an environment that's been quite hostile, who feel that coming into a larger organization makes sense. And I think, when we look at M&A, we're really looking at sort of, 3 or 4 things in terms of, do they tick boxes for us? Do they bring scale to existing capability? Because clearly scale is beneficial for us in terms of our business. Do they bring us into new markets, perhaps allowing us to access a client cadre that we don't currently focus on? Do they strengthen our investment capabilities? Either they give us more product that we will be able to take out to clients. So those are the sort of key areas that we look for in M&A. And I think I'm slightly skeptical about large scale M&A in the asset management sector. I think it's actually quite difficult to do well. But I think adding in additional capabilities into a business such as ours does make sense. Clearly we don't want to end up as a sort of home for every waif and stray in the market, but where it makes sense to add capability, to add scale, or to add access to clients, that's very much the areas that we will be looking for, Joffy.
Thank you. And then, Mike, another 2 or 3 questions have come through on the same theme. Talk about our product lineup. We've got a nice deep breadth of product, 40 plus products. And one of people is saying, how do we effectively monitor that? How do we look after that product set? And would you rather have more products or less products with more AM in fewer products?
I think it's really important that as a business we're relevant to our clients. I think if all we did was say UK small cap equities, which as we've seen from the flow charts have been very much out of favour with investors, that puts you in a very difficult position. So I think it makes sense to have a spread of investments. From my perspective, having a blend of equity, multi-asset and fixed income makes sense, because clearly the risk profiles of those 3 areas are very different. Clearly equities are more volatile than fixed income, and therefore the revenue streams that you generate from those 3 different groups of investment are different, and therefore that's good for us as a business. I think, clearly, where would we like that balance to be? Well, in an ideal world, we'd have 30 billion of AUM with 10 billion in fixed, 10 billion in multi-asset and 10 billion in equities, because, that would be a perfect balance for us. But I think I think one of the questions that's on the screen is, have you got too many products? I think it's fair to say, Piers, that we continually look at our product range. We continually assess the profitability of the products that we run. We continually assess the potential of the products that we run against the sectors that they operate within. So, if we're running a fund, say with, 25 million pounds in, the average size of the fund, the average size of a fund in that sector is say 200 million. What do we have to do to move our fund from 25 to 200 million? What is the impact on profitability if we do that? What is the performance like? Are we able to attract assets? And where we reach the conclusion that we're unable to do that, then we have to make changes. Now, those changes can be replacing an existing manager with a new manager, and we've done a number of those changes over the last 3 years or so. Or as in the case of, say, our European equity income strategy last year, we make the difficult decision to close the fund and return the assets to investors. So I think, we're very focused on delivery for the end client here. So as long as we feel we can deliver for the client and deliver good investment outcomes, then clearly having that broader product set makes sense. If we don't feel we can deliver for investors, if we think that something changes that means that product is not going to reach critical mass, then clearly we have to review it and take steps.
Yeah, and I think certainly from a distribution perspective, I would also add that when you go and talk to the intermediaries, institutional investors, to advisors, you want to make sure you're relevant. The world's evolved. We're not in a position where we kind of product pushers anymore. What we have to do as a business is listen to what our clients are looking for and provide solutions for them so they can meet their end customer objectives and outcomes they're looking to try and generate. So having that broad suite means that whatever meetings that myself and my teams go into to talk to clients will have something that's of relevance. And if you're relevant, you can always talk about, engage with, and talk about different products. If you have a narrow product set, then you can lock yourself out of a number of relevant meetings. Now, I've got some other questions coming through.
Good one on IT, and we've got the guy responsible for
exactly.
IT with us.
So let me bring that up now. So, Piers, one of the questions there. Now, what shape is your IT stack in? Do you have to do anything to invest any more significant improvement over the coming years? What have we been doing?
Great question. I think obviously we had the merger back in 2019. I think fortuitously, when we looked at both sides of the business, a core area for us is our order management system, where both sides of the group use the same system. So that's deployed across all of our fund managers and operations. I think if we look at our internal IT, yes, we've now harmonized that under one operating sort of platform. I think we continually invest CapEx into that, as you would expect, where we replace end-of-life systems or processes, and that is just a cycle that we go through. I think an area where we are obviously investing in and continually watching it is cybersecurity, making sure if there are new solutions that we can early adopt, whether that be AI solutions or whatever, to help us make our infrastructure more robust. And that is an area where we would be deploying sort of more investment. But from a financial point of view, we're not anticipating any significant material spend in this area over and above what we would normally do on an annual basis.
Okay, great. Thank you, Piers. I think perhaps another question that we can pick up, and I think there's one important. How do we retain fund managers, Mike? In a kind of rock star world that we talk about sometimes. What are kind of the KPIs, and how do you sort of retain fund managers?
Yeah, it's a good question. Obviously, we saw the news yesterday of one of our peers. I think we're not big fans of the sort of rock star fund manager. We don't really run what's sometimes been called a sort of rock star and roadie type organization, where the fund managers are the rock stars and everybody else in the organization are the roadies. We tend to work in a very collaborative way across our business. It is a very collegiate culture here for our fund management teams. They spend a lot of time sharing ideas, talking to each other, and I think that's one of the benefits of having fixed income, equities, and multi-asset all within one organization, and all sitting in one room, basically. That there is a real sense of sharing ideas to produce better investor outcomes. I've never really been a fan of sort of siloed fund management businesses where each individual team kind of keeps everything to themselves and doesn't share. I think you produce better outcomes for your investors where you are sharing ideas across and between teams. And that's very much the culture that we have here. So I think, one of the things that you do to help retain your talented FMs is you have a good culture within your organization. And I think we do tick that box. I think the other things that we look at, many of the levers that I think others use, is the remuneration for fund managers involves them having retained earnings within the funds that they run. We are big fans of fund managers who eat their own cooking, and so 2/3 of any bonuses that our fund managers generate get deferred and reinvested into the funds that they run, and that over time obviously builds up into a substantial asset base for them, but it also means they're very focused on the funds that they manage. And we also use our equity as a firm. We have a number of EBT and LTIP schemes that we use to ensure that our fund managers are aligned with the long-term success of the business as well. So I think it's, the sort of short answer to that question. It's a combination of having a strong culture where people enjoy working with like-minded people, ensuring that people are invested fully in their funds so that they are aligned and that they are aligned with the long-term success of the organisation.
Thank you, Mike. In fact, I've got another question that's come through as well, sort of asking, how do you think the market will view us if we launch our own MPS, whether it's an advisor or a discretionary market? And I think it's an interesting question to ask. And the way I would answer it is that we've seen over the last few years, increasing numbers of advisors simply no longer willing to be seen to be selecting funds themselves. They'd rather outsource that investment solution to someone else. And today, those are the MPS, the model portfolio solutions providers. And we've seen a huge number of these being launched by wealth managers across up and down the country, and a few of the asset managers as well. And how would we be held in regard? Well, most advisors that I talk have been asking us for quite a while now to launch an MPS because they already access our investing capability through a multi-manager or fund-to-fund structure, but they simply now want to be able to access our investing capability through an MPS structure. So we will be effectively meeting existing inherent demand. And I certainly know if I look at some other more complex wealth asset managers in the marketplace who have both MPS, who have asset management businesses, have a wealth management businesses, they can all sit quite complementary with each other. So from the perspective of our side, I think it's an additional additive to our overall business going forward. Perhaps on the
sorry, Geoffrey, I was going to say we've got one on sort of regulatory headwinds. Piers, is that something you want to sort of touch on? Anything specific that we're up against?
I mean, I think as an industry, though, it's an area which is not going to go away, and I think you have to embrace that. And that is why, we sit here with the headcount that we do. In that, you have to undertake and have a business that can deal with the regulatory requirements. And we can't suddenly reduce our workforce because we have to have all of these areas covered off. And I think systems, controls, and processes are fundamental. And it is really a barrier to entry to the smaller firms to make sure that this is not going away. It's an area of continual focus, and you need to make sure that we're resourced to be able to deal with it. Is it going to get easier? I doubt it. But as a group, we'll evolve, and as an industry, we get on and deal with it. And consumer duty is evolving from assessment of value. It's the next step, and as these come on, we'll just we'll grow and deal with it as it comes along.
And I think that's it sort of goes back to what we were saying earlier about the sort of M&A opportunity. Is that for a lot of firms who particularly where people have sort of branched out on their own, the increasing regulatory burden does effectively steer people to having a larger scale operation, and that I think is something that we as a business with a flexible platform that can grow assets under management, but with a strong risk and compliance and legal structure behind it, is able to provide a sensible home, I think, from an M&A perspective.
Thank you, Mike. I'm conscious time's on, so we've probably got time for another 2 or 3 questions. I think perhaps one that might be worthwhile just tapping into again, Mike. Maybe a bit too early to tell, but can you provide any further updates on Tellworth?
Yeah, it's a little bit early to tell. I mean, we're in that sort of limbo between having announced the deal and waiting for regulatory approval. The business actually has been performing well in terms of investment performance. We're keeping in regular contact with the team. Obviously we have to keep the 2 investment teams separate at this stage because we don't have regulatory approval for the deal. But our CIO has been having lots of conversation with their investment team. We've been having conversations with their operational team to sort of plan for the integration of those 2 businesses as soon as we get our regulatory approval. So it's a little bit early to give an update. We'll obviously be doing updates through our regular reporting cycle. And we really hope that something like this is helpful. We're sort of enjoying doing it, so we will continue to do these, I think, on a regular basis as well, and we'll be able to give updates through this format as well. Probably a bit early, Geoffrey.
Okay, no, thank you, Mike. Maybe time for 2 more quick questions. You talked about the fixed income team earlier anyway. Maybe another question to come through now. How do you think the growth has been developing? Maybe expand a little bit on
I mean, I think we're sort of quite pleased with the way that the fixed income team have developed. I mean, they joined us a little over 3 years ago. We ran virtually no money in fixed income. We had a very small corporate bond fund. There's maybe 30 million or so, and we had a small money market fund. And the guys have come in. It's been a big investment for us as a business. The fixed income team is a reasonable sized team. They had a really strong track record at Merion. We like them a lot culturally. They were a good fit for us, and they've slotted in really well. And we're pleased with investment performance since they joined. That they've done a really good job in what has been a really difficult period for fixed income investors. I think it's been quite easy to lose a lot of money in fixed income over the last couple of years, and the guys have done very well of avoiding that. Their performance numbers are amongst the best in the relevant sectors. They've got top quartile performance over the period since they've joined, and we've been successful in getting those messages out to investors through the distribution team. So I think in total across the funds and some segregated mandates that the guys run, we're about 1.8 billion there. We think this is a strategy that can grow to 5 billion and possibly further. So it is I think it's good progress in what's been quite a difficult market. As you saw earlier, over the last 2 years, there's been something like 3 billion of outflow from fixed income funds across the IA sectors. We've seen inflow, 550 mil last year, and I think we're starting to build some momentum. I mean, Joffy, from a distribution perspective, how are you seeing it? And in fact, where are you seeing demand now from our clients?
No, thank you, Mike. That is a really good question to ask. What we've tried to do is making sure that you listen to the market, listen to what the clients want at any one moment in time. Last year was very much fixed income back in vogue, having been sort of spent years in the wilderness. So as Mike said, we've benefited from that. I think one other question I got related to the same question, which has been what we do with advertising. The most important thing is to, if you're going to do stuff in advertising and whatever activity you do, you've got to lean into an opportune moment where you can see natural demand coming through. So during the course of the year, we start off with fixed income and advertising. Then we pivoted towards money market in the second half of the year as demand for cash rates went up. And we've seen flows into our money market funds. As a consequence, we've supported our multi-asset funds as well from an advertising campaign. And actually, what's interesting now, Mike alluded to this, risk appetite seems to be returning. Sentiment's improving. I know we're starting to see interest in our European Opportunities Fund that Mike referred to earlier, which tends to do well in kind of rising markets. We've seen an increasing number of clients asking more about our small cap capability, whether it's UK or US small caps or global small caps. In fact, interesting now, we've got a couple of lunches and dinners going around the country in events with advisors and wealth managers taking our fund management team out there. And we've had such strong demand that we've had to book a couple more venues just to meet demand. So it does feel like momentum's building around the small cap arena again, which is quite nice to see. And actually, Mike also referred to Matt Tillett. A strong manager came into the team, our investment team, just over a year or so ago, runs our UK Value Opportunities Fund. And I'm starting to see quite a lot of incoming inquiries onto that. So it feels now that we've got this stable of multi-asset. We have participated in that fixed income piece. We are participating in money market. And actually, as Mike says, we wanted to be in a position where when the risk appetite returns, we'll be in a position to benefit from that. And from what I can see from the teams on the ground, we're definitely seeing that.
Yeah, and I think it's fair to say from our perspective as a business, a return to net positive flow would be very good news. But I think what we've tried to do during the last couple of years, it has been difficult. But what we've tried to do is to make sure that we are match fit for when demand improves. And a lot of the work that we've done since the merger back in 2019 in terms of building a scalable operating platform, in terms of diversifying our product set so that we have relevant products for our clients to invest in. And then, with Joffy joining a little over a year ago, restructuring our distribution and marketing capabilities to ensure that we're getting the messages out there to those key fund buyers. We've done a lot of the groundwork. I think, if markets are a little bit better over the next year, 18 months, then I think we're very well placed and quite highly geared into that recovery. So, we're a lot more optimistic on the outlook than we've been for a while. So, fingers crossed that we do see we see that follow through during the course of this year and next. I think that's probably we've been on it for almost an hour. You've been very gracious with your time. Thank you for staying with us. I hope you found that a useful session. And I'll hand back to the guys at IMC to wrap us up.
Perfect. Mike, Piers, Joffy, thank you very much indeed for addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll be able to give you these back immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Mike, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, I mean, thank you very much for attending. Sorry it's been a tough ride on the shares over the last couple of years. We're all shareholders in this business as well. We've got significant proportions of our own wealth in the equity in this business. We really care about what happens. I think our fund managers really care about what happens. They are very, very focused on ensuring that they're doing the best for our clients, and our distribution team care about the business. They're out there every day, treading the boards and getting out in front of clients and explaining what we're doing and why. And it's important that you do that in the bad times as well as the good times. And I think we've been good at that over the last couple of years, and hopefully that will be reflected in improving fund flow as market conditions improve. Thanks, Piers and Joffy, for coming along today and sharing your time. Thanks to everybody for joining us, and we look forward to doing another one of these soon. Thanks for coming.
Thank you.
Perfect, Mike, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Premier Miton Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.